Good afternoon, everybody. Welcome to our webcast on selecting an option strategy. I'm Connie Hill. We get together every week at this time and discuss different option strategies. Now, today we're going to do something maybe a little bit different. I'm going to ask you a question. You can respond to this in the chat if you want to, but you don't have to. But have you ever been a victim of analysis paralysis? Meaning you see so much on the chart and you're looking at the trend and support and resistance and studies and moving averages, and you just kind of feel a little bit overwhelmed. Well, we're going to talk about something today that might help you with certain option strategies to kind of simplify your life. Okay, we're going to call it the KISS principle, which you're familiar with. Keep it simple, sweetie. All right. Now, I hope you're following me on X. I'm Connie Hill CS. Ben Watson, we want to welcome him to the chat. He's going to be helping me out answering your questions, maybe some of the things I can't quite get to. Ben is Ben Watson CS, and we'll post educational content out there throughout the trading day so that you can get little nuggets that we're noticing in the market. Okay, so it's free, it's easy, do so. All right, let's go through our disclosures and we will get into our agenda. Options carry a high level of risk and are not suitable for all investors. What we talk about today is for information and education only. It shouldn't be considered a recommendation. We're going to be using the Paper Money software application. It's for educational purposes only, but I think it's a fantastic tool to learn the platform as well as testing out different strategies you might not be familiar with. Past performance of any security or strategy does not guarantee future results or success. When we talk about probabilities, keep in mind they are the probability of something expiring or not expiring in the money, and they're theoretical in nature. All right, now I'm seeing some of you are saying, yeah, you've been stuck at times with that analysis paralysis. Yes, to be honest with you, probably all of us have at some time. All right. A couple events coming up here, a couple in New York. We're going to have our market drive event this weekend, and then in the first week of August, or I guess maybe the second weekend in August, we're going to have a workshop. No, I take that. Yeah, workshop in New York. So we're going to have a market drive in New York. A few weeks later, a technical analysis and option strategies workshop. People love these events. Mid-August, we're going to be in Chicago. So if you can get yourself there, you will be really happy that you did. Ben will kind of back me up on this because Ben is at almost all of these events. And we're nice to you. We feed you. We treat you like you are so golden. You're going to go, oh man, this is like Pamper Me Day. All right. Plus, you get to learn a lot of really good stuff that really helps you with your trading. So that's why we encourage you to do it, and that's why we do it. All right. Typically in this class, we want to take a look at the market conditions. They probably haven't changed a whole lot since we met last week, but we'll take a quick look at them. Many times we're going to talk about what we see in the markets and how that might influence the selection of an option. And we're always going to look at examples, and we're going to follow up on some existing trades as well. Now, I have two objectives here today that I want to accomplish with you. Objective number one is to try to teach you something so you don't have analysis paralysis. The second one is to answer some questions. You guys did fantastic responding to the surveys we've had the last couple of weeks. And one of the things that several of you had questions on were this idea of covered calls, whether you're selling it against a stock or whether you're selling it against an option. So we're going to do some follow-up and answer those types of questions as we get into it. And then we'll move on to our potential solution for the analysis paralysis. So let's hop over here to our Thinkorswim. Got our SPX chart up, gapped up today, and the market was able to hold those gains. You can see our peak here in February was at 61.47. Man, we're getting closer. 60.92 is where the S&P closed today. And you can see essentially bullish activity here, right? It was getting a little bogged down, a little bit sideways, but not nearly so much right now. Now the NASDAQ's going to look fairly similar. Oh, would you look at that? Man, it went really close to its peak here that it had in February. So this was, man, a bunch of twos, 2, 2, 2, 2, 2, 2. And today it looks like we closed at 220. or 22,190. So pretty dang close, getting back up to those peaks. We'll see if the NASDAQ has resistance there or if it blows past that previous peak. The VIX, as we look at the VIX, if we're having a bullish day in the market, you might know what's going on with the VIX, and we had a nice big drop in the VIX. It had been up here in this 20, plus 18 range, and it looks like today where it's closing is around 1756. So definitely giving us the idea that, okay, people aren't quite as concerned as maybe what they have been, and kind of like bullish market. I think probably almost every sector was up today. I can't vouch for that unless we go look at the what do you call it on the Market Watch tab. I'm going to click on it so I remember the name. The Visualize. Okay, there was lots of green on our Visualize tab. Just lots of bullishness in the market. Now, let's jump to our topic about covered calls. I don't know if a lot of you are involved in the covered call strategy or something that we're kind of adapting to that in this class. We put out some long options, longer dated options, with the idea that we wanted to sell a call against it, like you might a stock, but we're going to do it with an option. That's called a diagonal, and we were going to leg in to these diagonals. Previously, we had looked at some stocks for covered call purposes. So here are the positions we have up. We're going to just look at a few of them and talk through it. So on the chart, let's take a look here. We're going to start with Qualcomm. And Qualcomm had been downward trending for a bit, bottomed out here in April, and then started putting in higher highs and higher lows. Now I'm going to kind of move into here. We bought on Qualcomm, we bought a long call option for October. We got in on this day. We had seen the breakout take place here, and because the class takes place when the market's closed, this went in the next day. So that's the day we got in. We talked about things a little bit last week and said, maybe it might be time to sell a call against it, even though I thought maybe that would have a little bit of a run first, but it didn't. It pulled back. We went ahead on the 17th, which was Tuesday. I think I got that in before our class took place. We sold a call against that option. Well, the idea was collect a little premium, and then we'll see, if it kind of dilly-dallies for a little bit, maybe we can collect some additional premium there, right? We sold initially an option for $287, so $287 for that one contract. We ended up buying it back today. The reason we bought it back today is because we saw this strong move. In fact, I did that pretty early this morning. I was like, okay, let's take what we could from that option. It helps us a little bit to lower the overall cost of our longer option in October. So we bought it back. We had to buy it back for about 201. So we only ended up with about 86 cents or the equivalent of $86 on it. But $86 is $86 to help lower that. Now, what are we going to look for now? We're going to look for the same thing. We are going to look for this stock to run up. Maybe it finds some resistance here. I don't know. But we're going to look for weakness to move in. So we're going to look for it to maybe head up to a previous area of resistance or peak. And then we're going to look for it to maybe start to pull back. And as soon as we can see that, which really requires attention every day, as soon as we see that, that's when we want to sell that call. Okay. That should answer a couple of your questions that had the question on the covered calls. I'm going to add one other thing here on this chart that I think is helpful, and that is our MACD, because our MACD histogram can show us when kind of the momentum is starting to fade. We'll just leave it the default here like it is. And so our MACD is down here, which I actually don't like. Let me fix that real quick. I am just such a creature of habit that I always look at the bottom to find my volume. So I'm just going to stick it in that place. All right, here's our MACD. And so, ideally we'll be looking for that MACD to run up again. And maybe as it starts to lose a little momentum, kind of like maybe what it did here when it goes from bright green to darker green, that's the first signal that the momentum is starting to wane. that might be good timing to sell the call against it. Okay, so that's what we're going to look for on this. We're going to have this trade in our portfolio for a little bit of time here. All right, let's take a look at AMD. Now, AMD, similar type thing. We got in on this day. That was the 11th of June. And on it, we bought, I didn't write down which option it was. Let's go just take a look here real quick. We bought a November option, and we had sold against it a July 135 call. Now you can see that it was here today, but we no longer have that position. Why is that? It's because I went and bought it back. Okay. Initially for that position, we brought in 580. No, that's not true. We brought in 310, but today we had to go buy it back for 580. So we bought it back at a loss. Now, sometimes that may happen when we sell calls, but look at it was going kind of sideways, sideways, sideways. Great. Time decay, time decay, time decay, a little bit of inching up. And then today, big pop and run. And that's why I went ahead and bought it back at a loss. Now, our position overall is positive. But the one thing you have to recognize is that that option that we bought back for a loss does not calculate in here. Once it's closed, it's gone. Okay. So to kind of track these kind of trades, you really need a trading journal of some sort, whether it's one that we have on the website for you, you can use that, or maybe something you create, whatever it is, to manually track it, because this is not representing that position anymore because it's closed. So on that, I told you we lost about 310. And so just take off $310 off of this, and this would say, okay, now we're up about $700. We're really not up 1,000, even though on the long position that we still have, yeah, that's what we're up on that particular trade. So same thing. If it rallies up and starts to be quite weak, then we may sell a call against it as well. Now, sometimes stocks will get in a pattern where they kind of trade sideways, which it had been at the time we got in here. Sometimes that changes and they start trending really nicely. In that scenario, we might choose not to sell anything against it. We might say, we like the growth that we're getting from that option. We're just fine not selling anything against it. If we do, we'll be legging into it. And we'd want to make sure that things have really slowed down. So that's why that MACD can be really handy here. Now, somebody had asked a question, and this goes out to the survey. You guys did, I told you, you guys did great answering questions, or asking me questions to cover. And one of those questions was, let me read it to you. It says, what do you do when a covered call or a diagonal blows through its strike price? Okay, this one was 135. This one we bought back. What did it do today? Boom, it blew through it. And so you do have a choice. Your choice is go buy it back at a loss because you think this stock's on fire now and you think it's going to keep going up. We never really know that, but maybe that's what it's looking like. And so you buy it back either at a loss, or maybe you just lock in a little bit of money like we did on, let's see, on Qualcomm. That's what happened on it, right? We brought in some premium, we bought it back. We gave up some of those gains to buy it back, but it looked like that big shift was occurring. And so what do? You can leave it alone. You can see if it pulls back. In the case of a covered call and you've got the stock sitting in your account, when you get into that strategy initially, many people feel like, I don't want to be too tied to the stock, meaning I want to be okay if I get called out. I want to be happy if I keep it. I want to be happy if I get called out because the stock is taking off, because they know, gee, I get the gain of the growth of the stock from when I bought it to when I get called out on my strike price, as well as the premium you brought into the trade by selling that call. And so if it's a position you dearly love, and you are married to, and you never want to separate from that stock, then those are the kind of stocks you might not sell covered calls on. Okay, you might just leave them alone. Or if they're a stock that's really giving you a lot more performance than what you could get out of a covered call, then you might choose not to use it there. But you get to choose. Okay, so sometimes people think, oh, it's a horrible thing if I get called out. And it's like, well, not really. You made some money here. Okay. And so you just have to, I think it's more helpful to decide that up front if you're willing to part with the stock or not. Okay. If it blows past it and you just want to see if it comes back because you don't care if you get called out and you don't care if you keep it, then you can be happy either way. So I hope that answers those questions for those of you that submitted several different questions along those lines of what we just covered here. Where is that trading journal? Should we go find it? Let me show you. And then I see we've got a survey out there. Let me show you where the trading journal is while we talk about that. If I can multitask, sometimes that's a tricky thing. Let me get there this way. I have logged into, I was logged into Schwab here. Let me come back out and log in again. I know. Let me back in, please. Maybe we'll do a little refresh there. Grab that. Okay. Let's, I'm going to type it in manually. Maybe I disrupted something. What a pain to have to type in your password. I know. Sometimes happens to the best of us. All right. I'm going to come over here to Learn. Come down to Schwab Coaching. And this is where you find links and access to all the events we have. Our classes, our calendar, what we're doing. And the trading journal is going to come off of this calendar here. So I'm going to come down and we're going to go to View the Calendar. And we're going to come over. There's a couple places where you can see it. I'm going to show you where it's on for my short verticals class. We teach that at 2 p.m. Eastern time on Thursdays. And when you come to the short verticals class, look at this trading journal. Okay, you can download that trading journal. We've got a couple of tutorials to help you. One tutorial is just kind of the basics of that trading journal. And the second one is specific to verticals. So those are helpful little tutorials that you might use to help you kind of track expenses. We can't show you in our classes the trading journal in the sense that we can't put trades in there, but it's pretty straightforward. Put in your ticker symbol and your strike price and the price of your option and some of those details. All right. Now, if you are a subscriber to our Trader Talks and you don't want to get in via Schwab, you don't have to, right? You can come over here to our Trader Talks channel. After you hit that little subscribe button down in the bottom right-hand corner, it's blue. Select on that and you can see what's going on right now. Actually, this setup coming because I logged in it before our class started. There's Ben Watson. What's with all these ticks and points? Actually, Ben had a great class today. I was in the chat in our futures class. And you see kind of what's going to be coming up next. Okay, so this will be the last class of the day here. We'll start again bright and early in the morning with Trader Talks right at the opening bell at 9:30 Eastern time. Okay, so this is where you can find our recordings. You can come over here to the playlist, look up some of these previous classes maybe that you missed on selecting an option strategy. All right, so hopefully you found it. All right, you guys, I've showed you where the journal is. Hopefully you're happy now. Okay, Let's Grow says you got it. You got it this time. All right, sounds good. All right, so objective number one was to talk about kind of some of the covered calls. I'm going to backtrack for just a moment because I had seen a survey in the chat. And those of you that have been with us know that from time to time, we'll have a survey out in the chat. And it's really an easy survey. 2 questions. You can just click the radio button on a scale of 1 to 10 this, on a scale of 1 to 10 this. Click, click, you're done. There are 2 additional questions if you want to go there. And I also encourage you to use it as space to communicate something with me, which several of you did last week in talking about the covered. Could we talk a little bit more about covered calls? When's the right time to do it? What happens if it blows through my strike price? Those were perfect things for you to include in that real estate. So feel free to do that. Share that information with me because I love to incorporate the things that are on your mind. I like to address when we have our sessions. Now, class isn't over yet, but if you'll just click the link right now, just let it sit in the background. Then when we're finished, it'll be ready to go. And we always appreciate you filling out the survey for us. Don't we, Ben? Yes, Ben knows we appreciate that. Okay, let's go back to our Thinkorswim. And just real quickly, we have some additional ticker symbols that we had put in our portfolio for the purpose of selling calls against. So one is USB, one is Verizon, one is GM. You can see we have 100 shares of stock. At the end of the day, typically what you might want to do is go back and see, is it the right time for us to sell a call against this stock? And I'm just going to pull up UBS as one because it's pretty representative of what's happening with most of those today. And that is, ideal timing would have been back here to sell the call, right? After maybe a pop-up and a rollover. On this day, had you been watching that is a candle that's basically saying, I'm fatigued. It gapped up, it ran up here, and then it closed pretty low on the day. And it closed lower than where it opened. So that's a sign of fatigue. And then we got the confirmation of that the next day. So one of those 2 days would have been ideal time to sell that call. Now, right now, as I go out and I look at it, I'm like, well, the stock's starting to move along here. So we want it to move along. We don't want a covered call on it. We're going to wait for this kind of a scenario to occur. One thing you have to do, though, is you do have to be good at looking at it every day. And honestly, I am not good at looking at some of our paper money trades every single day, but that's what you need to do so you can leg into it properly and try to max, a good benefit out of selling a call against your stock. Okay, so most of the ones that we had sitting there for that purpose, it's just not good timing for them right now. Okay, let's go. Let's attack our second topic here today, which actually was kind of my primary topic, which is analysis paralysis. I'm a chart person. You guys know I love the charts. I love to dissect them. In fact, that was something I found very rewarding early on in my trading careers. I just really liked the charts and that technical approach. And so we'll talk about technicals a lot in my classes. But you get a lot of things on your mind, right? You're like, well, what's the trend? Well, is that the short-term trend or the intermediate trend? And what about support and resistance? Those are important things to identify. And what about the MACD study? What is it telling me? And is there good volume today? Is there not good volume today? What's the candle look like today? Right? All those things are just pinging your brain because we're teaching you those things, right? So they just come flooding in. And so sometimes you're like, there is so much going on the chart. I just don't get it. Okay? You're like, there is just too much information. So we're going to do something today that I'm going to show you. It's a non-discretionary system. We're going to look for one rule to get in, one rule to get out, and that's it. Okay? One rule to get in, one rule to get out. Now, this particular system might not be appropriate for all the option strategies that you know. It can be useful for stocks. It can be useful for an option that you are treating like a stock, like you've bought a longer term dated option with the idea that it's going to substitute as your stock. These could be beneficial for that, but you want to do some testing in your paper account, see how it works for you. And those aren't the only ones. Those are the ones that come to mind immediately for me that I think might benefit from it. And they're kind of the sample trades that we're going to do as we find this. So what I've got on the screen, I didn't mean to leave it there from the beginning, but I did. So I just kind of left it alone, is I have just two moving averages, and I'm going to get rid of this MACD because we don't need the MACD. We actually don't need volume. The only thing that we're going to look at is a 5 simple moving average and a 20 simple moving average. Okay. The 5 is kind of that pinky purple color, and the 20 is this bluish one. Okay. Now, the idea here, and I'm going to bring up a different stock. The idea here, and I did a real quick video on this last week, this idea of the 520 crossover. And we've got this stock Mosaic. And kind of, you know, the first part of the year, it's just kind of been a little bit sideways. And we do see the 5 and the 20 crossing over each other. Well, the entry signal that we would want to use is the purple pink line crossing above the blue line, having the 5 cross over the 20, and that's going to be our entry point. So I'm just going to kind of zoom in on this bit of information here. And so had we been doing this, we would have identified an entry to get in on this stock, probably like this green candle day. And we would not have had an exit till it crossed down below. So the day that the 5 crosses the 20, which looks like about on that red candle, that's when you would have exited. So in this case, the entry date was, let me look at that entry date. It was April, get to something here. It was April 17th, and we would have stayed in until when the crossover occurred on June 10th. That's when that day was June 10th. Okay. Now, I'm not going to say that every single crossover of a 5 over a 20 is going to lead to a big run for 2 months. This one happened to, and so it's a kind of a helpful example. But had we used this strategy, say earlier, I'm going to kind of scroll back here, when it was more sideways, it could have been a little iffy. When I say iffy, we could have had some whipsaws. We could have been in and out fairly quickly. We could have got in, say, for example, on, looks like the crossover occurred, right? I guess it actually occurred here. Okay, it was where the crossover was. And so this day is the 10th of January. And we would have stayed in until the crossover occurred. It looks like probably on this day, the 7th of February. So that would have been less than a month. And it could have been a little bit of a gain. Okay. But there might be some times when the stock's a little bit more sideways, when it might give you some whipsaws. Okay. So you want to keep that in mind as you're looking at some stocks. Now, we have a watch list of stocks that we've said we're going to use in this class. We're going to use them for bullish trades and bearish trades. Chris says, you know, would this work better for less volatile stocks, or does it matter? I'm going to say something instead, Chris. I'm going to say it will. I shouldn't say will, because I can't predict everything, right? But it would tend to be a little bit more effective with stocks that are trending, whether they're bullish, whether they're bearish, as opposed to trendless stocks. Stocks that are kind of going sideways probably wouldn't work so well for. Okay. Journey says, is there a gap down study or scan? There certainly is. We will look actually at the scans. I'll point it out when we get over there, that are pre-built. Okay, the Thinkorswim software already has built into them. Well, we have a watch list of stocks that we're willing to trade. We create this in our short verticals class, which is on Thursdays, but we use it in this class too. The last time we created that was on May 29th, so it's kind of getting time. Maybe next week we'll update our watch list, okay? But every single one of these stocks were either on the S&P 100 or the NASDAQ 100. So we're looking for stocks that are liquid. We want them to have a lot of trading activity, not only with the options or on the volume of the stock, but then that might lead us to activity and open interest on the options. So we put our volume, I think we put our volume at about 2 million as a minimum. Okay, that's where these came from. Now, for what we're talking about today, what we might say is, well, let's find a crossover on this list today. Okay, so you could take your merry sweet time if you wanted. Let me come out here, and you could just kind of go through. My arrow down didn't work. You could just kind of arrow through it. Okay, might take a little bit of time, or you can do what I'm going to show you. All right, we're going to do what I'm going to show you. We're going to go over to the scan tab, And who was that was looking for the scan? Journey. If you come over here to the scan tab, come over here to Stock Hacker, and come over here to this menu and then load scan query and come to public, you're going to find several different public ones, but here's a gap down and a gap up. Okay, that seems to be what you're looking for. And so they update daily. They have this little purple icon to the side that basically means it's a dynamic list, which means it updates when the data changes. Okay, so throughout the day, that watch list would change. Okay, what we're going to do here is we're going to use one criteria. Okay, we're going to put in here a study. Remember, on studies, they don't work in paper, so you have to run it on your live site. If you're not using your live site at the moment, you'll have to go over there to run this. We're going to choose a study. We're going to come down here to crossovers, and we're going to come down to moving average crossover. Okay. Now, as we come here, it has some defaults in there, but we're going to change them. And actually, well, actually, that is the reset. I need to get rid of these extra pieces of information. I'm just going to get rid of them because I just only want you to see the one thing in here because I just want to simplify it. Okay, that's the only thing we need on here is this moving average crossover. And we're going to say we want the 5 simple moving average to cross above, instead of 30, we're going to put 20. That's what we're looking for. Okay. Now, I could just run this generically on all stocks, and it'll give me a list of maybe what, well, actually, that's too long of a list because I didn't have any other criteria in there. So this is an unruly list. But what we're going to do is we're going to say intersect with, and we're going to pull in that watch list that we're using for our class. So we're going to come over here and we're going to choose class short verticals 529 because that's the list. And we're just going to let it tell us which one we're having crossovers today. All right. Oh, one of them came off. That's interesting. Earlier today, there was a third one. We were going to take a look at it. But let's talk about Wells Fargo and Altria. They are stocks that are on our list that are stocks we're willing to trade with. Okay. Let's go look at Wells Fargo. Let's see if we see the crossover today. All right, so on this crossover, I'm going to kind of zoom in on what's happening here recently. And yesterday, man, it was close to crossing over, but today it really did cross over. Okay, so today would be the first day that we would see the 5 crossing over the 20. That we could use and for this scenario we're talking about here. This we're going to, for our class purposes, we're going to use as an entry signal. We're not going to see what resistance is, what support is, what we think the short-term trend is, what the candle today is, right? Today could be actually an exhaustion candle, but we're not going to use it. We are simply going to say if it crosses, we're going to stay in, or get in rather, and we're going to stay in until a cross comes and gets us out. So that's what we're going to do. Now, this is called selecting an option strategy. This this simple setup where we're just looking for one thing might not be appropriate for all the strategies that we typically look at in this class. And that's why I've said for this system today, we are only going to do some longer dated options that might act like a stock substitute. Okay, so let's go over here to the trade tab and let's see what we've got. We've got December, we've got January, and on here, let's go ahead with the January. Let's go 6 months out. It's 200 days, and that might be enough time. We don't know. All right, and what we're going to do, we're going to come down here and we're going to look for the first 60-something delta. Why the first 60-something delta? Because we want it to have some intrinsic value. We want that delta to be a little higher so that if the price of the stock moves $1, then we get 60 cents or something change in the price of the option. So that's what we're going to look for. So we're going to buy January. Looks like the 63 delta is the one to have. So we're going to go ahead and buy the January 75. Okay. Notice the bid-ask spread here. Do you like that? Ooh, 20 cents on something that's over $8. That's awesome. That's great liquidity. We love this. Look at all these thousands of contracts out there. Yeah, that's the kind of thing we're looking for. So on our option, we're gonna buy it. Maybe we get it at the midpoint price, maybe not. We're gonna go ahead. We're just gonna submit it at whatever the natural price is right here, with the intent that we're gonna get in. Now, we're not putting a stop on this. Why are we not putting a stop on this? Well, the reason we're not putting a stop on it is because we could if we wanted to, actually. We could get out on a technical crossover and we could build that in. Haven't planned to go quite that far today because of time, but we could. Maybe we will run a little bit of our discussion into next week as well. Okay. But the idea is, yeah, we're looking for the crossover. Sometimes we might see a cross early in the day and it might disappear. That's a possibility, right? You could see maybe a stock dropping and then rallying the rest of the day. And so like at the beginning of the day, it crossed and then it went away. That could happen. If you have that kind of fixed in there, that scenario could happen. So we're going to put a mental stop, and we just know if the 5 crosses below the 20, we're getting out. We don't care if it's tomorrow. We don't care if it's in 3 months. Once we get that crossover, we're out. And that's why we're buying a lot of time, because we don't know how long it could go, right? We're going to treat it kind of like a stock, not so much a short-term holding of a stock, but maybe something more like a little bit more intermediate, okay? Which is why we're buying time out to January. Okay, so we're going to put it in. So did I hit send? I didn't hit send yet. We're going to hit confirm and send. I'm going to put a note in here, and the note I'm going to put in says this is a 520 crossover. That's a note to us, from us to us, right? That we're doing the 520 crossover, so we know what to use as the exit signal. We want that note in there, and then we're going to put this in our option strategies grouping for the stocks for this class, or the trades for this class, I should say. Okay, that's number 1. There was one that came on earlier, and it didn't show up in the scan when I just showed it to you, and I just ran it for you, so I'm a little bit curious to see what happened with this. Oh, would you look at that? This is Abbott. I want to kind of back up here a little bit. Abbott Labs, I mean, it's having a big day, right? Big candle, big bullish engulfing, popping through resistance really strongly, but it did pull back a little bit. And in this little pullback towards the end of the day, I'm going to say, I guess the cross went away. Oh, look how close that is, man. These are kissing cousins here. Let's see. The 20 is 133.85, and the pink line is 133.80. Okay, it's 5 cents short of crossing over. Okay, now that's why it didn't come up in our scan, is because we've got closing numbers and it did not cross. In that kind of a scenario, you could wait for it to cross. You could say, well, let's see what tomorrow brings. See if it follows through. If it follows through, then maybe you'll get your cross. Now, the problem with that is that we are not going to be here together tomorrow. Okay? So we are going to act like it really closed there, but truly, that's the rule. You wait for it to cross. Okay? Because it could change just like it did today. It had crossed over at one point when it was sitting clear up here, and then, a little bit of pullback, a little bit of selling off at the end of the day made the difference so that it was not a crossover. Frank says, would you consider selling a call against this long-term option, and if so, when? You certainly could, but I wouldn't introduce it necessarily into the system right now, because typically you're going to have different rules for selling calls, kind of like what we talked about earlier in the session with covered calls, and the same thing with a diagonal, right? That's kind of taking the place of the stock, that longer dated option. And so the rules are different. Okay, I think it would be trickier, say with Wells Fargo or Abbott, to do that, but it doesn't mean you couldn't. Okay, you would probably want to do some testing and determine what kind of rules you might want to use there. Okay, so come out to the trade tab here. Looks like we've got November, we've got January. What else do we have on Abbott? Or we have February. Let's do another January option. Okay, 6 months worth of time. We would love to stay in it as long as it's going, man. We would stay in the trade. And you know what's nice out here? This is clear out in January, you guys. Can you see all the contracts that are out there? There is a lot of trading going on. Okay, where is our first 60-something strike price? Boom, right here. This is a 61 delta. It's $1.35. This may have spread out a little bit wide artificially after the market closed here. Just kind of looking at, when I looked at it earlier today, I think the spread was about 50 cents. Okay, which 50 cents on a $12 option is awesome. Right now, it's a little bit more than that, right? It's like 90 cents. But even if we divide 90 by 12.50, that's going to be less than 10%. And sometimes 10% is the line that some people draw, that line in the sand. But we'll put it in for a midpoint price here. Okay, we'll try to get somewhere between the two. Let's go ahead and click on the ask price here. Let's move it to the midpoint. Let's go down to 12. Oh, I went the wrong way. Let's go to the midpoint, 12.10. We'll see if we get it. I'll watch this in the morning. I'm going to make sure that we get filled on it. Okay. Same thing here. Confirm and send. We're going to put a note to ourselves. This is a 520 crossover. So we know what the exit rule was. We know what the entry rule is. And we're going to put it in our option strategies bucket. All right. This is something we're going to track. We're going to pull this up next week. Okay, if you're kind of coming in a little bit late here, we are looking at simplifying entry and exit rules. Entry rules that we're going to get in on. I'm going to go back to Wells Fargo. Let's see. Wells GC. There we go. CG. What am I doing wrong? Wells Fargo. I've got 4 letters. GC. No, it's the 3-letter one. I'm being a dork here. Let's see what it really is. WFC. Okay. WFC. Get it right, Connie. There we go. There's our Wells Fargo. So if you got here a little bit late, that's all we're looking at is the crossover, the 5 above the 20. That is our entry signal. Nothing else. You can see no other studies, not even volume, nothing else. It's called a non-discretionary system. It's just like one rule to get in. What's our rule to get out? Do you know what it is? I sure hope so, right? 5 crossing down below the 20. That's going to be our exit signal. Now, let me ask you, do you think that these are rules that are simple enough that you could possibly test them yourself in your paper account? You think so? I'd like you to answer that in the chat. Okay. Basically, we looked at market conditions. Today, I focused us only on one strategy, a longer dated option, to see how this might work, kind of filtering it in specifically for that type of time frame for the option, something longer dated that we're treating as a stock substitute. And then we looked at some examples for covered calls. That was the second thing I wanted to give you information on, because we had a lot of questions about that from the survey previously. All right, some of you are feeling good about it. Excellent. All right, so that's going to be my challenge to you. Take it up in paper, test it out, see if it's something that can work for you. You can use your own watch list. You can use a class watch list. We'll be updating that soon. Okay. Ben, thank you so much for your help and being here today and catching questions. I'll remind you again of the survey that is out in the chat. Ben is going to post that again for us, so it's nice and easy to find. And again, we appreciate it when you take the time to fill that out for us. And anything you fill out, I'm going to read. My manager, Scott, you guys know Scott. Scott's going to read, because we want to hear your input. And I love you answering, little things like, yeah, this is what I'm struggling with, so we can address it in one of our systems, or one of our sessions, I should say. All right, we're going to follow up with all of those trades next week. We'll see how they're going. And again, appreciate you filling out that survey. Have a great evening, everyone. We'll see you again bright and early tomorrow at the opening bell. And maybe by then, Ben and I will have had some things we already posted in our X account that you're following, that you get those little nuggets on. We'll see you then. Bye-bye.